You need to see what just happened in the gold market, because what I'm about to show you isn't just unusual, it's unprecedented. And if you're holding cash right now, or if you've got retirement savings sitting in traditional accounts, the next few minutes could change everything. Let me paint you a picture of what's happening right now, at this very moment, in the physical gold market. The vaults are emptying. Not slowly, not gradually. We're talking about a systematic, coordinated drain of physical metal that's accelerating by the day. And the whales, the big institutional players who move markets, they're not just buying, they're hoarding. They're taking delivery. They're pulling metal out of the system entirely. Here's what that means. When you or I buy gold, we might buy a few coins, maybe a small bar. We're talking ounces. But when I say whales, I'm talking about entities that buy in tons. Central banks, sovereign wealth funds, ultra-high net worth family offices managing billions. These aren't retail investors. These are the players who have access to information you and I will never see. They have economists on staff. They have direct lines to treasury departments. They know what's coming before it hits the news. And right now, they're acting like the building is on fire. Let me give you some numbers that should make your hair stand on end. In the last quarter alone, central banks purchased over 300 tons of gold. That's not a typo. 300 tons. To put that in perspective, that's roughly 10 million ounces. At current prices, we're talking about $27 billion worth of physical metal pulled out of the market by central banks alone. And that's just what they're reporting. Many central banks don't disclose their purchases until months or even years later. But here's where it gets really interesting. The COMEX, the major commodities exchange where gold futures trade, they're seeing something they've never seen before. Registered inventory, that's the gold that's actually available for delivery, has dropped to levels that would have been unthinkable just 2 years ago. We're talking about inventory levels that are now at a 20-year low. And at the same time, the number of contracts standing for delivery, meaning people who actually want the physical metal instead of just trading paper contracts, that number is surging. You see what's happening here? It's a squeeze. A real physical squeeze. Not the kind of squeeze you see in meme stocks where retail traders pile in for a few days. This is institutional money, serious money, saying we don't want your paper promises anymore. We want the actual metal, and we want it now. Let me tell you a story that illustrates exactly what's going on. There's a family office in Singapore, manages about $8 billion for a tech billionaire who made his fortune in semiconductors. Smart guy. Very smart. Last year, his team reached out to 3 major bullion dealers trying to purchase 50 tons of gold. Not futures contracts, not ETF shares, physical bars. They wanted it delivered to a private vault in Singapore. Here's what happened. The first dealer said they could do it, but it would take 6 months. 6 months. For a commodity that's supposed to be liquid, that's supposed to be readily available. The second dealer quoted them a premium of 4% over spot price. 4%. On a $135 million order, that's an extra $5.4 million just for the privilege of getting physical delivery. The third dealer was the most honest. They said flat out, we can't source that much metal right now. Not at any price. Not in any time frame we'd be comfortable committing to. That family office ended up splitting the order across multiple dealers, multiple countries, and it took them 8 months to accumulate their position. 8 months of persistent buying, paying premiums, dealing with delays. And this is happening at every level. Smaller buyers are getting quoted wait times of weeks or months for quantities that used to be available overnight. Now you might be thinking, okay, so there's high demand, supply and demand, prices go up. That's basic economics. But what you need to understand is that the gold market isn't like other markets. It's not just about supply and demand in the traditional sense. The gold market has been operating on a fractional reserve system for decades. Just like banks don't keep all your deposits in the vault, the gold market doesn't keep all the gold that's supposedly available actually sitting in vaults ready to go. The LBMA, the London Bullion Market Association, they're the center of the global gold trade. Trillions of dollars worth of gold trades through London every year. But here's the thing. Most of that gold doesn't actually move. It's allocated and unallocated accounts. It's paper claims on metal that might be in a vault somewhere, or might be leased out, or might be counted multiple times across different balance sheets. And now, for the first time in a generation, people are calling the bluff. They're saying, show me the metal, deliver it, put it in my vault, and the system is creaking under the pressure. Let me give you another example. There's a pension fund in Texas, manages retirement money for about 200,000 public employees. Teachers, firefighters, municipal workers. Good people who worked their whole lives and deserve a secure retirement. Last year, their investment committee made a decision to allocate 5% of their portfolio to physical gold. Not gold mining stocks, not gold ETFs, physical metal. They put out an RFP, request for proposal, to major dealers. They wanted to buy about $400 million worth of gold, roughly 150 tons, and have it stored in a segregated vault where they could audit it, verify it, know it was actually there. The responses they got back were eye-opening. Multiple dealers said they couldn't fulfill an order that size in less than a year. One dealer said they could do it, but only if the pension fund was willing to accept a mix of different bar sizes and purities, which would make auditing and eventual liquidation much more complicated. The pension fund ended up having to scale back their allocation. They could only get about half of what they wanted in a reasonable time frame. And this is a well-funded, well-connected institutional buyer with serious money to spend. If they're having trouble sourcing metal, what does that tell you about the state of the market? Here's what's really happening behind the scenes. The gold market has operated for years on the assumption that most buyers don't actually want physical delivery. They want exposure to the price. They want to trade it, speculate on it, hedge with it. So the system developed where you could have 100 ounces of paper claims for every 1 ounce of physical metal. As long as everyone played along, as long as most people were happy with paper, the system worked fine. But something changed, and it changed fast. Starting around 2022, we started seeing a shift. Central banks, particularly in Asia and the Middle East, started buying physical gold at a pace we hadn't seen since the 1970s. China's central bank has been adding to reserves every single month for over 2 years now. India's buying. Turkey's buying. Poland bought 100 tons in a single year. Singapore, UAE, Qatar, they're all accumulating. And it's not just central banks. Sovereign wealth funds, the investment arms of oil-rich nations, they're diversifying out of dollars and into gold. Family offices, the private investment vehicles of the ultra-wealthy, they're doing the same thing. Even some hedge funds, the smart money that's usually chasing returns in stocks and bonds, they're allocating to physical metal. Why? What do they know that the average person doesn't? Let me connect some dots for you. The global debt situation is completely unsustainable. The United States alone has $36 trillion in federal debt. That number is growing by about $1 trillion every 100 days. Every 100 days. The interest on that debt is now over $1 trillion a year. That's more than we spend on defense, more than we spend on Medicare. We're paying more in interest than we're spending on actual government programs. And it's not just the US. Japan's debt-to-GDP ratio is over 260%. Italy's over 140%. France, Spain, the UK, they're all carrying debt loads that would have been considered catastrophic a generation ago. And the only way they're servicing this debt is by keeping interest rates artificially low and printing more money. But here's the problem. Inflation. You've felt it. Everyone's felt it. Your grocery bill is higher. Your rent or mortgage is higher. Gas, utilities, insurance, everything costs more. The official inflation numbers say it's moderating, coming down to 3% or 4%. But anyone who actually buys things in the real world knows that's not the full story. Real inflation, the inflation you experience in your daily life, is much higher. And the whales, the institutional players, they understand what this means. They understand that when you have unsustainable debt and persistent inflation, there are only two ways out. You either default on the debt, which would crash the entire financial system, or you inflate it away. You print more money, you devalue the currency, and you make the debt worth less in real terms. Both options destroy the value of cash. Both options destroy the purchasing power of anything denominated in fiat currency. And that's why they're buying gold. Because gold can't be printed. Gold can't be inflated away. Gold is the ultimate store of value when currencies are being debased. Now, let me pause here for just a second because this is important. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, accounts that are denominated in dollars, you need to understand that there are ways to protect that wealth. I put together a free guide on how gold IRAs work, how you can get physical gold into your retirement account without triggering tax penalties, without having to liquidate your positions and start over. It's in the description below. No obligation, just information. Worth looking at if you're concerned about what we're discussing here. All right, back to what's happening in the market. Because the inventory drain isn't just about central banks and sovereign wealth funds, it's happening at the retail level too. Go try to buy gold coins right now. American Eagles, Canadian maples, even generic rounds. The premiums are insane. You're paying 8%, 10%, sometimes 15% over the spot price just to get physical metal in your hands. And the wait times, depending on what you're buying and where you're buying it from, can be weeks. I talked to a dealer in Florida last week, guy who's been in the business for 30 years. He told me he's never seen anything like this. He said in 2008, during the financial crisis, there was a surge in demand. People were scared, they wanted gold. But back then, the supply chain could keep up. Mints ramped up production, dealers could source metal, and within a few weeks the premiums came back down. This time is different. He said the mints are running at full capacity and they still can't keep up with demand. The US Mint, the Royal Canadian Mint, the Perth Mint in Australia, they're all back-ordered. And it's not just coins. Small bars, kilo bars, even larger institutional-size bars, everything is tight. And here's the kicker. The price of gold, as I'm recording this, is hovering around $2,700 an ounce. That's near all-time highs. In a normal market, when prices are at all-time highs, you'd expect demand to cool off. People would say it's too expensive, I'll wait for a pullback. But that's not happening. Demand is accelerating. People are paying record prices and they're still buying everything they can get their hands on. What does that tell you? It tells you that the smart money isn't looking at gold as an investment that might go up or down. They're looking at it as insurance. They're looking at it as a lifeboat. And when you think the ship is sinking, you don't haggle over the price of a lifeboat. You get on it. Let me take you back to 1971 for a minute. August 15th, 1971. President Nixon goes on television and announces that the United States is closing the gold window. Up until that point, foreign governments could exchange their dollars for gold at a fixed rate of $35 an ounce. That was the foundation of the Bretton Woods system, the monetary system that had governed global finance since the end of World War II. Nixon said it was temporary. He said it was necessary to protect American interests against speculators. But it was never reversed. From that moment on, the dollar became a pure fiat currency, backed by nothing but the full faith and credit of the U.S. government. And what happened to gold? In 1971, gold was $35 an ounce. By 1980, it hit $850. That's a 24 times increase in less than a decade. And that wasn't because gold became more valuable. It was because the dollar became less valuable. The purchasing power of the dollar was being destroyed by inflation, by money printing, by the exact same policies we're seeing today, but on a much larger scale. Now, I'm not saying we're going to see a 24x increase from here. The circumstances are different. The market is different. But the underlying dynamics are eerily similar. Unsustainable debt, persistent inflation, a loss of confidence in fiat currency, and a scramble for hard assets. Here's another piece of the puzzle. The BRICS nations, Brazil, Russia, India, China, South Africa, they've been talking for years about creating an alternative to the dollar-dominated financial system. And it's not just talk anymore. They're actually doing it. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT, the Western-controlled financial messaging system. They're accumulating gold as a foundation for a potential new monetary system. China alone is estimated to have over 4,000 tons of gold in reserves, and many analysts believe the real number is much higher because China doesn't fully disclose their holdings. Russia has been buying gold aggressively for over a decade, building their reserves to over 2,300 tons. India's reserves are over 800 tons and growing. These aren't random purchases. This is strategic positioning. These countries are building a foundation for a world where the dollar is no longer the undisputed global reserve currency. And gold is the cornerstone of that foundation. Now, you might be thinking, okay, but I'm not a central bank. I'm not a sovereign wealth fund. I'm just a regular person trying to protect my savings and plan for retirement. What does all this mean for me? Here's what it means. When the whales are moving, when the big institutional players are repositioning their portfolios in a major way, that's a signal. That's information. They're not doing this for fun. They're not doing this because they read a blog post or saw a YouTube video. They're doing this because they have access to data, to analysis, to insights that tell them something big is coming. And the inventory drain we're seeing, the fact that physical gold is becoming harder and harder to source, that's not a temporary blip. That's a structural shift in the market. When you have more claims on gold than there is actual gold available, and when people start demanding physical delivery, the system breaks. Prices have to adjust. Premiums have to widen. And people who waited, people who thought they could always buy gold whenever they wanted, they find out the hard way that the metal isn't there. Let me tell you about what happened in 1980. Gold hit $850 an ounce in January of that year. It was a frenzy. People were lining up outside coin shops. They were melting down jewelry. They were selling family heirlooms. Everyone wanted to get in on the gold rush. But here's what most people don't know. The people who made real money, the people who actually preserved and grew their wealth, they weren't the ones buying at $850. They were the ones who bought at $200, at $300, at $400. They were the ones who understood what was happening before it became obvious to everyone else. They positioned themselves early, and when the crowd finally showed up, they were already sitting on massive gains. The same thing happened in 2011. Gold hit $1,900 an ounce. Suddenly, everyone was talking about gold. Coin shops couldn't keep inventory. Premiums were through the roof. But again, the people who really benefited were the ones who bought in 2008, 2009, 2010, when gold was $800, $1,000, $1,200. They saw what was coming. They positioned themselves, and they were rewarded. Right now, we're at $2,700. Is that the top? Is that the bottom? I don't know. Nobody knows. But what I do know is that the fundamentals driving this market are stronger than they've ever been. The debt is higher. The money printing is more aggressive. The geopolitical tensions are more severe. The loss of confidence in fiat currency is more widespread. And the whales are buying. Not selling, buying, accumulating, taking delivery, draining the inventory. Here's something else you need to understand. The gold market is relatively small compared to other financial markets. The entire above-ground stock of gold, all the gold that's ever been mined in human history, is worth about $15 trillion at current prices. That sounds like a lot until you compare it to other markets. The global stock market is worth over $100 trillion. The global bond market is over $130 trillion. The global real estate market is over $300 trillion. So what happens when even a small percentage of that money decides to move into gold? What happens when institutional investors decide to shift just 2% or 3% of their portfolios into physical metal? The gold market can't absorb that kind of inflow without massive price increases. There simply isn't enough metal available. And that's exactly what we're starting to see. The early stages of a major reallocation. The whales are moving first, because they always move first. They have the resources, the information, the ability to act quickly, but eventually the trend becomes obvious to everyone. And that's when the real move happens. Let me give you one more example. There's a billionaire in the Middle East, made his fortune in oil and gas. Very private guy, doesn't do interviews, doesn't seek publicity. But people in the industry know him. Last year, he liquidated about $2 billion worth of European real estate. Prime properties in London, Paris, Monaco. Properties that were generating solid rental income. Properties that most people would consider excellent long-term holds. And what did he do with that $2 billion? He bought gold, physical gold, had it shipped to a private vault in Switzerland. When someone asked him why would you sell income-producing real estate to buy a metal that just sits in a vault, he said something that stuck with me. He said, real estate is only valuable if the system that enforces property rights remains stable. Gold is valuable regardless of what system is in place. Think about that. This is a guy who's lived through political upheaval, who's seen governments come and go, who understands that the rules can change overnight. And his conclusion is that physical gold, metal, that you own outright, that you can hold, that you can move, that's the ultimate insurance policy. Now, I'm not saying you should liquidate all your assets and buy gold. That would be extreme. But what I am saying is that the people who have the most to lose, the people who have built massive wealth and want to protect it, they're taking this seriously. They're allocating significant portions of their portfolios to physical metal, and they're doing it now, not waiting to see what happens. The inventory drain is real. The COMEX registered inventory is at 20-year lows. The LBMA is seeing unprecedented demand for physical delivery. Central banks are buying at the fastest pace in decades. Sovereign wealth funds are accumulating. Family offices are accumulating. Even some pension funds and endowments are starting to allocate. And on the other side of the equation, mine production is basically flat. We're not discovering major new gold deposits. The easy gold has been mined. New projects are more expensive, more difficult, more time-consuming to develop. Recycling can only provide so much supply. The fundamental supply-demand balance is shifting in a major way. So what happens next? If I had to make a prediction, and understand this is just my analysis based on what I'm seeing in the market, I think we're in the early stages of a multi-year bull market in gold. I think we're going to see $3,000. I think we're going to see $4,000. And depending on how bad the fiscal situation gets, depending on how much more money gets printed, we could see numbers that sound crazy right now. But more importantly than the price, I think we're going to see a continued tightening in the physical market. I think premiums are going to stay elevated. I think wait times are going to get longer. I think it's going to become increasingly difficult to source significant quantities of physical metal. And if you're someone who's been thinking about adding gold to your portfolio, if you're someone who's concerned about inflation, about currency debasement, about the stability of the financial system, the time to act is now. Not when gold is $4,000 and you're paying 20% premiums and waiting 3 months for delivery. Now when you can still get metal, when you can still position yourself before the crowd figures out what's happening. The whales have already figured it out. They're already moving. The inventory is already draining. The question is, are you going to wait until it's obvious to everyone? Or are you going to position yourself now while you still can? This isn't about getting rich quick. This isn't about speculation. This is about preservation. This is about making sure that the wealth you've built, the savings you've accumulated, the retirement you've planned for, that it's protected against the very real risks we're facing in the current economic environment. The gold is leaving the vaults. The whales are taking delivery. The system is being tested in ways it hasn't been tested in decades. And the people who understand what's happening, they're acting. The only question is, will you?